new money moving into it, which I say is bullish for Bitcoin, because at the end of the day, the highest return when you're stabilizing a giant $600 million data center before you sell it to Microsoft is you rent it to Bitcoin miners. So you've got these massive facilities being built. Another indice, which I think is a foreshadow of demand, because when we get policy on Bitcoin and it gets indexed to 1% in a $900 billion fund, that's really good towards getting that price up to 100,000. That's the only way you're going to get it, because if there's volatility, you've always got the underlying bid from the sovereign wealth fund. You have to be bullish if you believe in regulation. That's my point.
You do see these exchanges go belly up, and you do see 90% of cryptos go to zero, in which case you have to refer back to the Amazon chart at .com, the .com era, which went down 95%. So if that worst case occurs, you're talking about a $3,500 handle on Bitcoin. Now, again, at that point, everyone's like, oh, I'd buy as much as I can. But remember, you'll probably be so scared at that point. I like to tell people is that the 10-year yield is very much a forecaster, right? So initially the Fed was going to have to be so aggressive with all these 75 basis point hikes. So prior to those hikes, you really saw the 10-year yield surging to the upside. Now, interestingly enough, let me show you this here chart. Let's go to a different 10-year yield chart here that I have. But basically, if we look at that, and I'm not getting the right one up, but bottom line is there was a key trend line hit right here, where if we stretch this out, you can see that this trend line, the yields when we got to about 3.5% tagged that line. And you can see what's happened. I mean, it was you couldn't have nailed the better top in the yields, but notice what's happened. Since then, we've now seen the Fed kind of being a little bit more dovish, even in spite of the hot jobs number. And I think, again, yields are likely starting to think about maybe the chance of a recession. And we all should remember that the bond market is known as the smartest of the markets. That big money from the bond market usually is a better forecaster than short-term stock market moves. So I think that, again, I wouldn't be surprised, and I have it forecast that we could see in the next 6 months a move down on the 10-year yield to basically close to 2%. Before it starts to stabilize and maybe turn back up. And the only way that's going to happen is if we slip into a steep recession where people start speculating that we now maybe will see the Fed loosen up on policy and maybe not be so aggressive.
Nominal GDP is running 7-8%, right? Inflation's 9%, so you're getting negative real GDP of 1%. Retail sales, nominal retail sales are up, 7-8%, all these things. You just came down from Mars. Where do you think Fed funds rate is? And I mean, anybody in their right mind would say Fed funds has got to be 7, 8, 9%, right? At least the inflation rate. Now I tell you, you just came from Mars. Fed funds rate is 2.5%. What do you do with your investments? I think that's how people should need to be thinking about this. And because the answer is simple. Say, I don't want to own financial assets of any kind. I'm not going to buy it. Interest rates might come down in the short run, but I don't want to buy a 10-year, treasury yielding 2.5. I don't want to own stocks at the highest valuations. Literally today, even after the correction, I think we're very vulnerable. Corporate profits, I mentioned relative to GDP. Buffett said any time spent above 6% of GDP, you can't assume that indefinitely into the future. We hit, last year we hit 11% of GDP. It's fallen back down to about 10% of GDP. But if we fall back down to, 6%, which Buffett said was on the high side, right? That means corporate profit margins are essentially cut in half. Like I said, so that means that the PE ratio, instead of being 16, 17 or whatever it is 32, 35, something like that. And, so what multiple do you put on that? Well, you probably, put a 15 multiple on normalized earnings. And so that takes you down, 50% from today's levels.
The beauty of technical analysis is we don't have to worry about fundamentals, about whoever's spinning a positive spin, like is Bitcoin the next world currency? Like it totally doesn't matter. We saw that it was important. It broke down from a rising trend line, which is the first means momentum break. So when you break down from a rising trend line, momentum breaks, but often it tricks people because after that, there's like a Neko move back up. And then people, we're in the clear, but it refuses to do a new high. And then it tumbles down, breaks below horizontal support. And like Kevin identified on the chart, once you're below that, you have to favor more move down until the chart proves to you otherwise, that it can close back above those levels. And until it does that, the bias has to be downwards. There was a vacuum when it broke out above $18,000 or $19,000. It went up fast. It created a base on top around 40, 60,000, 30,000. And once you break down below that, there's not that many buyers that bought on the way up. So it just vacuums all the way down back to the previous base. And that's what we call a reverse symmetry move. So that's one of our techniques that we could use in TA, that we know, okay, there's vacuum, it's going to go all the way down. And then when there's that huge base where people previously believed there was a low watermark for Bitcoin, it hits it again. And then after that, it starts bouncing around that area until the market decides if it wants to try to go down below those levels or try to bounce.
Cryptocurrencies and Bitcoin are a play on tech stocks, and that's maybe partly due to the fact that cryptocurrencies haven't been around for a huge amount of time. So we just don't know how they're going to behave if and when the stock market's going to a much more prolonged and serious decline, rather than just the usual short corrective phase that we've seen over recent years. So if we have a repeat of the sort of thing that happened in the 1970s, and we see downward to sideways trending stock markets for a number of years, we just don't know how cryptocurrencies are going to behave in that kind of environment. So this is where the technical analysis comes into its own, because you don't need to worry about what the narratives are, what the fundamental stories are, all the arguments that are going on Twitter and YouTube and all that kind of stuff. The technical analysis will tell you, it'll tell you straight away if Bitcoin and cryptocurrencies are doing what they normally do and what they usually do. And
I think that might be the catalyst to push us to that 25.5 level. So I wouldn't be surprised if the initial reaction is people's kind of breathing a sigh of relief, saying, okay, we're past this nasty storm. I mean, granted, it's still inflation, right? So it's not like inflation's negative or down to zero, but at least we're not seeing higher numbers. And I agree with you, the lagging indicator of jobs. I mean, I'm sure you've talked about this, but like every day I see a new big mega company reporting new layoffs. And so even though we had a strong jobs number, at some point, all these companies laying off people, it's going to filter through. My guess is the next jobs number, we start to see that. And that's one more signal that the Fed probably has to take a slowing approach to raising rates. And I did see this stat recently about how many car loans are being falling behind on their payments. And I think you're starting to see that. And what's so scary about this scenario is that it's not only a slowing economy, but we obviously, the car loan aspect, what that tells us is that it's not necessarily the slowing economy yet that's impacting, it's inflation. So you throw a slowing economy, like people losing jobs with inflation, and the idea is that, I mean, you're going to see a lot of defaults out there.
At the abyss of the recession is when gold bottoms, it's when silver bottoms. Overlay the US recessions as defined from the data from the Fed. Every single middle of these recession bottoms is where gold bottoms before. Gold and silver will sniff the monetary imbalances required by the government to get you out of the recession. So for me, recession fears, I love it when people stop talking about inflation, because we were on the gold train in 2019 in June. Nobody was talking about inflation, and that was great. And we went up from 1,300 all the way to 2,000. And right now, I love the people talking about all this recession and deflation and less inflation, because that's where, from a mass media contrary point of view, if the TA starts aligning and people don't believe, they have a wall of worries, Patrick, in recession, silver can't go up, but then it keeps climbing up, keeps outperforming SPX, and the capital flows are going in commodities. Those are the best entries you'll ever get if you could see them with the charts. So for me, recessions, I welcome them. I want to see the recession because I know they'll open the spigots just to get out of it, and that will be rocket fuel for gold and silver.
I think you're going to see an economy that slips into a recession, then a worse recession, and the Fed, again, the inability initially to save the markets is by printing money like they have in past recessions is going to be very, very problematic, and it's likely going to trigger a domino effect into a worse recession. Now, at some point during this worst recession, probably in 2023, you're going to see the Fed say, oh my goodness, unemployment is now at 10%. You know, with a recession, you usually see a reduction in inflation. Maybe inflation's come back to 4%. And they're going to say 10% unemployment, we have to start printing again, or at least lowering interest rates to stimulate growth and get some of these people off of unemployment. And that's going to be, to me, that is where you see the pivot in Bitcoin from a risk on or risk on asset to actually becoming more like that gold and starting to take off in those printing money periods. The Fed has made it very clear that they have to get inflation under control, and they're willing to push the economy into a recession. So the market's hoping that inflation starts coming down, and that eases the Fed's pressure to kind of continue to lift rates. If that doesn't happen, I mean, you have to think the Fed is more than willing to push us into a steep recession to get that, and the market would not like that one bit.
Bitcoin trades 24 hours a day, and all crypto does. And that's a new beast for the compliance departments of these giant funds. But the demand, I mean, the reason I'm long now with all this volatility, we have 20% of our operating company's assets, that's our max, in crypto across 32 positions. I'm about to add Pollen, which is a decentralized telco. We've done a lot of research on. We like it. We think there's a lot of interest there, but that's a really fringe project. The point is, I'm trying to get ahead of the day, because we're all agreeing that at some point we're going to get policy. I need to be long before that happens, because that's the reward you're going to get, is when that stuff gets indexed, and whoever gets to index it, the demand for at least Bitcoin and Ethereum out of the beginning is insatiable. It is insatiable at the sovereign and pension level. As for all the skeptics that are, don't like crypto, they're going to watch that asset move into an indexed price, which I think is $60,000. When you look at UAE, it's Abu Dhabi is 95% of the capital. So you have to operate out of there. It's called the ADGM. And they set policy on crypto. They grant licenses for exchanges. But here's the thing that they won't do. They will not, let's call it, jump hop the SEC. They will not do this and make it a standard for their own sovereign wealth before the SEC gets a chance to move. And the reason for that is really political in nature. The largest manager of sovereign wealth in the world is BlackRock. That's Larry Fink. He's not going to do this until he gets the go-ahead from the SEC. And so they're not going to ever mess around with their largest manager. And Larry's telling them, and I'm speculating this, okay? I don't know this for certainty, but he's saying, let's just wait. Because when we get the SEC to approve this, whatever approval it is, and we'll build you the infrastructure so you can mark to market it so that you're staying compliant in your mandates, then they're going to put on their weighting. And so I think this thing is going to happen after the midterms, after we get the policy unstable. They're going to start looking at Bitcoin.
What we've seen today, and the 1973-74 bear market has a very high correlation to the bear market we've seen so far this year. And that's fascinating to me, because 73-74 was also the time when inflation was really taking off. The Fed was behind the curve. We went into recession. Fed, cut interest rates from 10 to 5%, and that cut in Fed funds allowed inflation to take off again in the late 70s. But they didn't do enough. But that stock market decline from 73-74, went from about 120 on the S&P to about 60. And there was a nice rally in there in late 73, which is kind of what we're seeing right now. And, if that price analog has some validity for what we're going to see going forward, it would take the S&P 500 down to almost 2,000 on the downside. That to me is just kind of helpful in understanding what is the potential for risk if we really do go into recession, we do see an earnings decline. Is similar to what you see in a normal recessionary environment. That would also be the type of. I really still like energy stocks. I think they're significantly undervalued. I mean, a lot of these things are trading 5 times cash flow and things still. And that's basically just a signal that investors think that they are at a cyclical peak, that oil prices are peaking out. From a purely technical standpoint, the oil price to me has traced out a typical bullish flag pattern over the last, several months, 4 or 5 months. If that, is a valid reading of that, then the oil price could break out to the upside sometime over the next few months and really surprise people on the upside. I'm talking, $150, $200 a barrel. If that, happens, then obviously the valuations for oil companies, oil producers and things is silly at today's prices. But I generally think investors need to focus on real assets right now. I think gold prices are dramatically undervalued given where real interest rates are today.